Every market collapse begins with hope. Before panic, before the crash, there's the spark of prosperity. A new technology, a financial innovation, or a government policy ignites a wave of optimism. Investors believe they've found the next great thing. And for a while, they're right. History repeats, not in exact numbers, but in emotions. From the Dutch Tulip Mania to the dot-com boom, the first phase always feels like destiny, not risk. It's when growth appears effortless and profits seem inevitable. In the early boom phase, the real currency isn't money, it's confidence. When investors believe, banks lend. When banks lend, businesses expand. The illusion of endless opportunity fuels a self-sustaining feedback loop. Every modern boom begins with easy money. Central banks lower interest rates to stimulate growth and credit flows freely. Borrowing seems harmless. Debt becomes invisible, replaced by the promise of rising returns. From railroads to the internet to artificial intelligence, innovation amplifies optimism. Each breakthrough redefines what's possible. Investors convince themselves this time is different. As confidence grows, leverage follows. Borrowed money magnifies gains until it doesn't. Few remember that leverage is a double-edged sword. It builds fortunes fast and destroys them faster. The media becomes an echo chamber for success stories. Every headline reinforces the belief that the boom is unstoppable. Markets hit new highs, record profits, unprecedented growth. Greed disguises itself as logic. When ordinary people start investing, the boom reaches its social peak. Taxi drivers talk about stocks. College students open trading apps. Everyone becomes a market expert until the experts stop making sense. By the late boom, growth feels permanent. Every correction is seen as a buying opportunity. Debt balloons, but optimism blinds the crowd. It's no longer about value, it's about momentum. Behind the numbers, small fractures appear. Corporate earnings plateau, household debt climbs. Yet markets ignore the warnings because illusions are most powerful right before they break. At the peak of every boom lies a fever, not of disease, but of euphoria. Investors stop analyzing and start believing. The markets no longer trade on fundamentals, they trade on faith. The most dangerous phrase in finance is always the same. This time is different. Each generation convinces itself that technology, intelligence, or innovation has defeated the old rules of risk. But the laws of economics never retire. Banks and investors, blinded by rising prices, loosen their standards. Lending becomes reckless. Speculation is rewarded. The system feeds on itself. More debt, more demand, more illusion. In every mania, heroes emerge. Star traders, tech founders, and influencers become icons of the age. Their confidence infects the masses. The crowd begins to believe not in markets but in personalities. As prices climb higher, the fear of missing out takes over. Investors stop asking, is it worth it? They only ask, how much higher can it go? Logic yields to momentum. The media amplifies the euphoria. Headlines shout records, analysts praise unstoppable growth, and skepticism disappears. The narrative becomes unstoppable until it suddenly isn't. Euphoria spawns bubbles in every direction. Art, crypto, real estate, tech, everything gains value simply because it can. When speculation becomes the economy, the foundation begins to shake. Amid the excitement, a few cautious voices emerge. Analysts warn of overvaluation. Economists speak of unsustainable growth, but the crowd laughs. To question the boom is to betray it. Behavioral economics explains what happens here. Confirmation bias, herd mentality, and greed overpower logic. People see what they want to see, profits, not peril. In the final stage of euphoria, markets reach an unsustainable high. Leverage is maxed, confidence peaks, and volatility hides beneath calm waters. The tipping point is near, invisible, yet inevitable. Every collapse announces itself quietly. The air thickens with unease, not yet panic, but something close. The market still climbs, but momentum slows. The data whispers what the headlines won't. Analysts begin to notice strange patterns, slowing growth, flat earnings, or falling demand. Numbers that once confirmed the boom now raise suspicion. But investors shrugged. One bad quarter doesn't end a dream. Stocks trade at impossible valuations. Investors justify it by inventing new metrics. Price-to-reality ratios no longer matter, only belief does. The first cracks appear in the credit markets. Banks quietly raise lending standards. Liquidity begins to dry up. The same institutions that once fueled the boom start to retreat. Smart money begins to exit quietly. Institutional investors sell before the headlines catch on. The retail crowd celebrates new highs, unaware that the exit doors are already crowded. Global tensions rise. A trade dispute, a war scare, a political scandal. Any spark can light the fuse. Markets that once ignored geopolitics now react violently to uncertainty. Central bankers begin to sound cautious. Their language shifts from optimism to vigilance. Investors interpret warnings as reassurance. The illusion still holds. Headlines turn uncertain. Phrases like cooling market and technical correction replace breaking. The optimism fades, replaced by nervous laughter and subtle doubt. Even as warning signs multiply, investors rationalize the risks. It's temporary, it's healthy propagating. Cognitive dissonance keeps the illusion alive. One more rally, they say. The system reaches critical mass. Leverage is maxed, sentiment unstable, valuations detached. A single event, a missed earnings report, a policy mistake could trigger the unraveling. The stage is set. The market drops, then rebounds sharply. Analysts call it a healthy correction. Investors breathe a sigh of relief, convincing themselves that the storm has passed. But every rebound is smaller, weaker, and shorter-lived. Financial media clings to optimism. Headlines proclaim recovery ahead and buying opportunity of the decade. The narrative shifts from reality to reassurance because confidence sells. Governments step in. Interest rates fall. Stimulus packages appear. The public cheers, unaware that these short-term lifelines only deepen long-term fragility. Corporations, flush with cheap debt, buy back their own shares. Stock prices rise again, not from productivity but manipulation. The illusion of strength continues. Economists invent a new justification. This time is different. They claim technology, innovation, or policy will prevent another crash. But history whispers it never is. Retail traders see the rebound as proof of resilience. Social media buzzes with confidence. Everyone becomes a market expert again. They buy more, convinced they're catching the bottom. Indices recover. Volatility fades, but under the surface, credit quality deteriorates and debt piles higher. It's the calm before the true storm, beautifully deceptive. Pension funds, hedge funds, and corporations keep investing to maintain appearances. No one wants to be the first to admit the party's over. Collective denial becomes policy. Hope becomes a financial strategy. People cling to narratives rather than numbers. They'd rather lose slowly than admit it's over. Eventually, belief itself becomes unsustainable. Markets are systems of faith, and when enough people stop believing, prices collapse. But before that moment, the denial phase convinces everyone that salvation is just one rally away. It always begins with something small: a missed earnings report, a failed bank, a sudden default. The markets, once numb to bad news, suddenly panic. The illusion shatters, not because the facts changed, but because faith did. Credit dries up overnight. Lenders stop trusting borrowers. Interbank lending halts. Money, the lifeblood of modern economies, simply stops flowing. In leveraged markets, panic triggers margin calls. Funds are forced to liquidate. Each sale pushes prices lower, causing more margin calls. It's a downward spiral of self-destruction. Fear spreads faster than any virus. Confidence, once an abstract concept, becomes the most valuable and scarce asset in the world. In the digital era, a bank run doesn't require lines on the street, it happens online. Millions withdrawing in seconds. The collapse is invisible, silent, and total. Central banks intervene again, cutting rates to zero, injecting liquidity, buying bonds, bailing out institutions. But this time, faith is gone. The tools still work mechanically, but psychologically, the system is broken. Television anchors whisper words like meltdown and crisis. Images of traders shouting and graphs plunging flood the screen. The media amplifies the fear and feeds it back into the market. Politicians appear on camera, promising stability. But trust in leadership collapses alongside the markets. Every speech, every reassurance only deepens the sense of unreality. Behind the graphs are people losing homes, jobs, savings. What began as numbers on screens becomes an emotional and social collapse. The human toll of financial architecture reveals its hidden cruelty. When trust vanishes, so does value. Money, credit, and markets all rely on a shared belief. And when belief dies, civilization itself trembles. This is not just the fall of markets, it's the unraveling of human faith in the system. When markets finally stop falling, the silence is almost eerie. The noise of panic fades, replaced by disbelief and exhaustion. It's in this quiet that the rebuilding begins slowly, painfully, cautiously. Governments and institutions conduct autopsies on the system. Inquiries, hearings, reports, everyone searching for someone to blame. But deep down they know, the system failed because belief became a bubble. Every collapse forces a reckoning with debt. Loans that can't be repaid are eventually written off. Defaults are painful but necessary. In the ashes of bad debt lies the soil for new growth. New rules are written, new agencies created, leverage is restricted, transparency demanded. But regulation often arrives like medicine after the disease, curing symptoms, not causes. In the aftermath, anger replaces fear. People turn against elites, corporations, and central banks. Populist movements rise, some seeking reform, others revenge. Every crisis clears the field for new ideas. After the Great Depression came social safety nets. After 2008 came fintech and digital currencies. Collapse becomes the crucible of reinvention. Historians, economists, and thinkers rediscover old truths: that markets are human, that greed has cycles, that stability ironically breeds fragility. After collapse, people become cautious. They save more, borrow less, distrust speculation. But over time, memories fade. And as confidence returns, so does risk, and the cycle begins anew. Slowly, markets rise again. Investors return. Optimism rebuilds. Fragile, tentative, but growing. What was once ruin becomes opportunity. The phoenix rises, unaware that its ashes are already forming. Every market collapse follows the same rhythm: euphoria, doubt, denial, panic, collapse, and rebirth. The pattern endures because it mirrors us. Markets don't move by numbers alone, they move by human nature. And as long as hope and fear exist, so will the cycle.